Welcome to the world of stocks. This is where fortunes are made and dreams come true. It's time to talk about the stock market. A place where numbers tell stories and every tick of the clock can mean a new opportunity. It's not just for Wall Street bigwigs anymore. Today, anyone with a smartphone and an internet connection can participate. The stock market is your ticket to financial freedom. It's a way to grow your wealth and secure your future. Think of it as a marketplace for pieces of companies. When you buy a stock, you're buying a small part of a business. That's right, you can own a slice of Apple, Google, or even your favorite coffee chain. Imagine being a part owner of the brands you love. Now, I know what you're thinking. Isn't the stock market risky? Sure, there's risk, but there's also opportunity. With the right knowledge and strategy, you can navigate these waters. The stock market has historically outperformed other investments over the long haul. It's a proven way to build wealth over time. It's beaten inflation, real estate, and even gold. This makes it a powerful tool for preserving and growing your wealth. It's not just about getting rich quick. It's about making informed decisions and being patient. It's about growing your money over time, just like planting a seed and watching it grow into a tree. The stock market isn't some exclusive club. It's open to everyone. No matter your background or experience level, you can get involved. You don't need a fancy degree or a fat wallet to get started. All you need is a little knowledge and the willingness to learn. There are countless resources available to help you understand the market. Books, online courses, and financial news can all be valuable tools. So buckle up, because we're about to dive into the exciting world of stocks. Let's get started. Together we'll explore the ins and outs of investing, and you'll learn how to make the stock market work for you. All right, let's break down some key terms. First up, stocks. A stock represents ownership in a company. When you buy a stock, you're buying a small piece of that company. It's like owning a slice of the pie. The more shares you own, the bigger your slice. And here's the kicker. As a shareholder, you get to participate in the company's success. If the company does well, your stock value goes up. Now let's talk about shares. A share is a unit of stock. Companies issue shares to raise money. They use this money to grow their business. Next up, dividends. Some companies share their profits with shareholders through dividends. It's like getting a bonus just for owning the stock. Not all companies pay dividends, but those that do typically pay them quarterly. Understanding these basics is crucial. The more you understand, the better equipped you'll be to make smart choices with your money. Listen up, folks. Choosing the right broker is like picking the right tool for the job. A broker is your gateway to the stock market. They execute your trades and provide the platform for your investing journey. But not all brokers are created equal. You need to find one that fits your needs like a glove. First things first, fees. Brokers charge fees for their services. Look for brokers with low fees, especially if you're just starting out. Many online brokers offer commission-free trading on stocks and ETFs. But don't just focus on trading fees. Look at the whole picture. Some brokers charge maintenance fees or inactivity fees. Next, consider the tools and resources the broker offers. Good brokers provide educational materials, research tools, and market analysis. Also, check out their mobile app. Finally, think about customer service. All right, folks, it's time to take action. Opening a brokerage account is your first step into the world of investing. It's easier than you might think. Let's walk through the process step by step. First, choose your broker. Use the tips we discussed earlier to find one that fits your needs. Once you've made your choice, head to their website. Look for a button that says Open an Account or Get Started. Click that and you're on your way. Next, you'll need to provide some personal information. This includes your name, address, and social security number. Don't worry, this is standard procedure. Brokers need this information to comply with regulations. They'll also ask about your employment status and income. Be honest here. This information helps the broker assess your financial situation. Once you've chosen your account type, you'll need to fund it. And there you have it. You've opened your first brokerage account. Section 5. Smart strategies for newbie investors. Listen up, rookies. Now that you've got your brokerage account, it's time to talk strategy. Investing isn't about throwing darts at a board. It's about making smart, informed decisions. First rule, don't invest money you can't afford to lose. The stock market can be volatile. Only invest what you can afford to leave in the market for at least 5 years. Next, let's talk about research. Before you buy any stock, do your homework. Learn about the company. What do they do? How do they make money? Who are their competitors? Now here's a strategy that's perfect for beginners dollar-cost averaging. Instead of trying to time the market, invest a fixed amount regularly. Lastly, don't put all your eggs in one basket. Diversification is key. Spread your investments across different companies, industries, and even countries. Section 6. Diversification. Don't put all your eggs in one basket. All right, folks, let's dive deeper into diversification. It's a crucial concept in investing. Think of it as the investing world's version of don't put all your eggs in one basket. Why is it so important? Simple. It helps manage risk. If you invest all your money in one stock and that company tanks, you're in trouble. But if you spread your money across different investments, you're less likely to lose it all if one investment goes south. So how do you diversify? Start by investing in different sectors. Don't just stick to tech stocks or energy companies. Spread your investments across various industries. For example, you might invest in a mix of technology, healthcare, consumer goods, and financial stocks. But diversification doesn't stop there. You should also consider investing in different types of assets. Stocks are great, but they're not the only game in town. Consider adding bonds to your portfolio. For beginners, one of the easiest ways to diversify is through index funds or ETFs. These funds allow you to invest in a broad range of stocks or bonds, providing instant diversification. Don't forget about real estate. Investing in property can be another way to diversify. Real estate investments can provide steady income and potential for appreciation. Another option is to look into commodities like gold or silver. These can act as a hedge against inflation and market volatility. Remember, the goal of diversification is to spread risk and increase the potential for returns. By having a mix of different investments, you can better weather the ups and downs of the market, so take the time to build a diversified portfolio that aligns with your financial goals. And remember, don't put all your eggs in one basket. Diversify wisely and watch your investments grow over time. Section 7. The power of long-term investing. Listen up, people, this is where the magic happens. We need to talk about time. Time is an essential element in the world of investing. In the stock market, time is your best friend. The longer you stay invested, the better your chances of seeing significant returns. I'm talking about long-term investing. It's like planting a tree and watching it grow over the years. It's not as exciting as day trading, but it's a whole lot smarter for most investors. Why? Because it reduces the risk of short-term volatility. Because over the long haul, the stock market has historically trended upward. This means that despite short-term fluctuations, the overall direction is positive. Sure, there are ups and downs along the way. The market can be a roller coaster ride with thrilling highs and nerve-wracking lows. But if you zoom out and look at the big picture, the trend is clear. The market's long-term trajectory is upward. The market has weathered wars, recessions, and pandemics. These events can cause temporary setbacks, but they don't change the long-term growth potential, and it's still come out on top. Time and again, the market has shown resilience and the ability to recover. When you invest for the long term, you give your money time to grow. Compounding interest works in your favor, turning small investments into substantial wealth. You also give yourself time to recover from any market downturns. This recovery period is crucial for maintaining your investment strategy. Let's say you invest in a broad market index fund. This type of investment spreads your risk across many companies. In any given year, it might go up or down. Short-term performance can be unpredictable, but over 10, 20, or 30 years, the odds are in your favor. Historical data shows that long-term investments tend to yield positive returns. The odds are in your favor. Over decades, the growth is evident, much like the transformation of a city skyline. Remember, investing is a marathon, not a sprint. It's about endurance and staying the course. Patience and persistence are key. These qualities will help you navigate the ups and downs and achieve your long-term financial goals. Section 8. Staying informed, your key to success. All right, folks, let's talk about staying in the know. In the world of investing, information is power. But here's the catch. There's a ton of information out there. The key is knowing what to pay attention to and what to ignore. First things first, follow the news. I'm not talking about celebrity gossip. I mean business news. Keep an eye on economic indicators, company earnings reports, and industry trends. These can all impact stock prices, but don't get overwhelmed. Start with a reputable financial news site or app. Set aside a little time each day to catch up on the latest. Now let's talk about company-specific information. As an investor, you need to keep tabs on the companies you're invested in. Read their quarterly and annual reports. Look for press releases about new products, partnerships, or changes in leadership.